I think what we've observed in the last few weeks has been quite exceptional in equity markets, and in particular, as you pointed out, in European equity markets. To me, this is very much linked to a relief rally on, a hope that what we've seen this year in terms of rate hikes across the globe might come to a slower pace in the year ahead. But it's still very much centered into the inflation and rate debate, and maybe it doesn't take into consideration enough what the growth backdrop might be next year. And we continue to see, lagging economic data that is relatively robust. But when we look at the forward-looking data and sentiment indicators, those are starting to looking quite weak. And so it's very important to consider the current price move and valuations on what could be a weakening of the fundamentals from a growth perspective in the months and ahead. So in a way, this short-term rally that we've seen could potentially be a tactical opportunity to scale back from some of these equity exposure and, seeing what happens next, really.
Do you rotate into cash or do you move into another asset class? And if so, which one?
So I think overall we have seen valuations improving really across the spectrum. So there is an element that tells us today, well, you are getting better value across a variety of assets than you were at the beginning of the year. But at the same time, you're getting slightly better value from cash as well. And in an environment which is proving to be extremely volatile, we've seen volatility obviously increasing in the equity space throughout the year. We've seen exceptional volatility within the fixed income space this year. Then cash could be quite an interesting place to sit in as we're looking for opportunities. And what is interesting is that, we've seen quite a lot of volatility, obviously, this year in the fixed income space, which was quite new and surprising for many investors. And it's going to be interesting to see, how much this volatility persists in the year ahead within the fixed income space, because that might mean that even if today we have overall, better entry points, better yields and better valuations within fixed income, given the very complex macro environment that we're in and the uncertainties around inflation and around growth, there might continue to be volatility in this part of the market as well. And that could provide investors that have more of a tactical and dynamic attitude towards market for opportunities. And so in this respect, cash could be an interesting home and an interesting asset to use in a higher volatility environment, especially in what we've experienced this year, which was a highly correlated environment across asset classes. So there hasn't been really many assets that have provided diversification for multi-asset investors throughout 2022. Now, if we were to encounter a very significant slowdown in growth or very high level of recession, you might expect that from this level of yields in the fixed income space and sovereign bond space in particular, you might start to get some diversification coming through. But it's still something to be very well aware of that we haven't had any of it this year, really.